Hey, good morning, options traders. Well, a question that's coming up these days, that is in April to May of 2022, and who knows for how much longer, but traders are asking, why is it difficult to roll for an 80% credit during high volatility, such as we're experiencing now? So most of you who follow my channel know that I usually talk about when you are rolling an option, let's say from the $100 call to the 105, that's a $5 difference in strikes. As a general rule, you'd like to get 80% of that difference, or $4. Well, I've had some traders saying, well, that seems to be very difficult to do when volatility is so high. Well, why is that, and what can you do about it? Well, good question, so let's go find out. And before we do, as always, please be sure to click like. It definitely helps to promote the channel and is really appreciated. So first off, remember what rolling with verticals is all about. Let's say that you buy the $50 call and the stock is now moving in your favor, and rather than just selling it for a relatively small profit, you'd like to hang on. But at the same time, you want to manage that risk just in case it does an about face on you and you end up losing everything. So this is where rolling comes in. What you can do is you could sell this $50 call and simultaneously buy, let's say, the next higher strike, maybe the 55. Well, those two trades right there, selling the 50 call and buying the 55, is selling the 50-55 vertical spread. And because you are selling that spread, it is a credit. But notice that when this trade is executed, you're not going to be short the vertical spread. Why? Well, remember, you were initially long the $50 call, so the sale of the $50 call just cancels that. And after the trade is executed, you're just left with the long $55 call, exactly what you wanted. You rolled or switched from the 50 to the 55. And in the process, you put some cash in your pocket, and that's what's reducing this risk. So again, you'd like to get 80% of that difference in strikes. And the reason for that is that if you roll for too small of a credit, you're going to continually push that break-even point out further. You might get some of your cash back and maybe not even all of it, and end up kind of locking yourself into a loss. So you definitely want to give that stock some room to run. So this is a pretty good metric, this 80% rule, to give you an idea if that option is ready to roll. So here's what this one would look like. Here's our long $50 call. There's our bend at 50, and let's say that you initially spent 10, so that would be the maximum loss. After the roll to the 55, you have switched from the blue to the red. Now you've got your bend right there at 55. So the main reason for doing this is that you want to shift this blue line up. You want to lift this maximum loss to a lower level. So in this case, we did get a $4 credit, so now my maximum loss isn't 10, it's now 6. But here's the trade-off. I'm going to push that break-even point forward. Notice that the blue line is shifted a little bit further to the right here on the red, and that means your break-even is now a little bit higher. And it turns out mathematically that if you got a $4 credit, that this break-even had to be shifted by the balance of that $5 strike, or $1 forward. So this is why you want to make sure you are getting a relatively large credit so that you have a relatively small shift in that break-even point. But ultimately, if that stock continues moving in your favor, you might be able to roll into something like this, where you have this guaranteed gain, and yet you still have unlimited potential gains. That's really what you'd like to do, especially in high volatility. But traders are finding out that it's really hard during high volatility, and again, that's the question of why is that happening? Well, go back to one of my favorite analogies is with a sports team where there is a time clock, let's say with football. So let's go back to the last Super Bowl, 2022, with the Rams and the Bengals. And the final score was 23-20. But let's say that we're now in the final 10 seconds of the game and that the Rams are in possession of the ball. The question is, how much confidence do you have in the Rams winning? Well, it's just about 100%. So even though it's only a 3-point spread, you've got a very high degree of confidence. Why? Because there's no time left. But what if this were instead the half? Would you have the same degree of confidence with a 3-point lead? Absolutely not. Lots of things can happen in the second half. A 3-point spread is really nothing at that point. So to have the same degree of confidence, you might say, well, I'd like to see the score 40-20 to still have that same degree of confidence that the Rams are going to win. So can you see what's happening? If you have a lot of time left on the clock, or in options terms, a lot of time until expiration, you need a very big distance. You need to have that option very deep in the money. That's like saying this option is definitely going to be a winner. It's absolutely going to be in the money at expiration. Why? Because it's so deep in the money now. Yeah, I don't care that there's still 6 months to expiration. It's 30 points in the money. But you can also contrast that with if your option is only 50 cents in the money, but you're right at the expiration bell. You still have that same degree of confidence. So here's the number one reason why it can be so difficult. Let's look at with just the movement in stock. And let's say that you currently have the $50 call and you want to roll to the 55. Well, in order to get a $4 credit for this, both of these options are going to have to be pretty deep in the money. So let's say that the stock is way out here. Well, both of these options are, relatively speaking, cheap, and therefore the distance between them, or the difference between them, is relatively small. Not going to be anything close to $4. As the stock starts moving higher, now the 50 call is in the money, the 55 call is starting to pick up a little bit more of the sensitivity because the stock is getting closer, and the difference between these two option prices is going to get bigger. If both options go in the money, now we're going to get really big. And if we're at expiration, we'll certainly be at $5. But prior to expiration, still not going to be at $5 for the difference between these two prices. We're going to need that stock to be way out here, maybe at 60 or 65. And if you have periods of high volatility, that's like saying we've added time to the clock. We would need that stock to be even higher before we would have the confidence that there is going to be a $5 difference between these two. So during high volatility, if you have a lot of time to expiration, you're going to need both of these options very deep in the money. And by both options, I'm talking about the one that you currently own and the one that you want to roll to. And if they are both deep in the money, then you're going to see that spread go to a minimum of $4 between them. If it's not, it's all relative. Then under that current volatility, it's not deep enough in the money. So if you are prior to expiration, and the further away from expiration, the more pronounced this effect, you need to use deep in the money options to make rolling easier. And unfortunately, traders want to do the opposite. They want to buy closer to at the money or out of the money that are just juiced up with lots of extrinsic value. They make that point spread extremely high, makes it very difficult to get out of. But if you go in the money, you can get away from that high implied volatility, and it makes it easier to stay on those positions when they move in your favor. And remember, as I've talked about before, you don't want to pick up nickels in front of bulldozers. During periods of high volatility, you want to stay in these positions, and this is the best way to do it. So using a deeper in the money option makes it easier to roll. All right, well, what if there's not a lot of time until expiration? Well, now you're able to roll more frequently. So one of two things have happened. You either bought a longer dated option, maybe it had 6 months to go, and now time has passed and maybe there's only 30 days or a couple of weeks. Okay, now you're going to be able to roll more frequently for exactly the same reason that we saw in our Super Bowl example. You might not have those two options very deep in the money, but there's also not a lot of time on the clock. And that's giving the options market more confidence that they will in fact expire in the money. Or perhaps maybe you only bought a 1-week option. All right, in that case, you probably will have the ability to roll more frequently. So here's the effect of time passing. Let's go back to these same two strikes. Here's your long 50 call. You'd like to roll to the 55. But let's say that the stock is just barely putting this one in the money. It's 55.01. Or we could even make it 55, but it's sometimes easier to make it that it's slightly in the money. So right now, this $55 call is 1 penny in the money. Well, would you say that that's giving you 100% confidence that this $55 call will be in the money at expiration? Go back to the Super Bowl example. Not even close. It's only a 1 cent move in the money. So let's say if there's 30 days till expiration, no, there's not going to be a $5 spread between these, even though both options are in the money. What about with 25 days to go? See, even though the stock price is not moving, the spread is going to move. What about with 20 days to go? 15, 10, 5. Yeah, see, now you're probably going to start pushing closer to $4, even though this option right here is only a penny in the money. And in fact, right at expiration, now you do have 100% confidence that both options are in the money, and the difference between their prices will be exactly $5. So here's another way to look at it. Here are different stock prices here in green. Here is the price of the 50 call and the price of the 55. Now I'm not showing the prices, I'm just showing the strikes. So imagine that the price is hiding behind each of these strikes. If I take the $50 call minus the 55, with the stock at 45, it's only a 4-cent difference. With the stock at 50, the difference is now $1.08. Stock's at 55, now it moves to 3.80. See, now we're getting closer to that 80% difference. Stock's at 60, now it's 4.91, and then at 65 and above, it finally converges to that full $5 difference. But that's also because we had 30 days till expiration. If I had only 10 days, then this convergence would happen much faster. If I put 120 days, it would happen much slower. But the idea is exactly the same. But now watch what happens if we go to scenario 2 where the stock's at 55.01. Same idea. Now these are days till expiration in green. These are the prices of the 50 and the 55. See, with 25 days to go, that spread is 391. With 20 days to go, now we finally hit that 80% mark. Even though both options aren't super deep in the money, there's also not a lot of time on the clock. 15 days to go, it gets pushed higher. 10 days to go, gets pushed higher, still not to 5. 5 days to go, still not to 5. Why? Because this second option is only a penny in the money. You're going to have to get very close to expiration before you see these two options go to the full $5 difference. So during periods of high volatility, the effect of the stock price moving higher or the stock price at a certain level and time moving lower is only pronounced. It makes it far more difficult to get these same levels. And that's because volatility is a way of really adding time to the clock. So here's a graph of what we just saw before. You can see that the difference between the two options is 0, but as the stock price moves, we start to quickly build up the difference, and then we eventually flatten out to 5 once we are either deep in the money or both options in the money with very little time to go. So I hope that helps to answer the question why it's so difficult to get this $4 credit. But the answer and the solution to it is you really should consider going deeper in the money when you initially buy that first option. That's going to get you away from that very high extrinsic value and make it much easier to roll for higher profits. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.